You're trusted with about £6.8 billion.
One of the biggest risks you face as an investor in equities is not having exposure. Those companies at the top of the market, the leaders, so we tend to change through time. I think the biggest issue for investors is maintaining a long-term perspective.
Welcome back to F&C Live. My name is Matt Gay, also known as the Quid Squid, and today I am joined by F&C's Investment Trust Fund Manager. We're talking about Paul Niven.
Great to see you, Matt.
How's it going? You all right?
I'm very well, thank you.
Good. Right. So should we get stuck into things?
Let's go.
Fantastic. So first of all, tell us a little bit about F&C and F&C Investment Trust.
So F&C Investment Trust is an investment trust, a closed-ended company, which is listed on the London Stock Exchange. It's got substantial scale, around £6 billion market capitalisation, and a member of the FTSE 100. It's got a very long history, launched back in 1868, and the original purpose was essentially to democratise investment, to provide small shareholders the same opportunity as large capitalists of the day, so really democratising investment more than 150 years ago. And we are the longest surviving collective investment scheme in the world, the oldest investment trust. So a lot of history there. And in recent decades, we've very much been focused on investment in listed equities, that's stocks and shares, and private equity. And our overriding objective is to provide growth in both capital and income for shareholders. So we think of ourselves as essentially a one-stop shop for investors looking for exposure to growth assets, listed equity and private equity.
Wow, I mean, that history must have such a big impact on the way you make decisions. But I think from a perspective from the general public, the average person walking on the street, what is different from, say, the way someone like myself would invest to the things that F&C do?
Sure. So there's a few points. Firstly, as an investment trust, we are closed-ended listed companies. We have an independent board of directors whose role really is to look after the interests of shareholders, and it's shareholders who own the company, obviously. We've got substantial scale, and that provides us with opportunities to access managers' investment strategies that might not otherwise be available to individual investors. We employ a diversified approach, so the manager of F&C is Columbia Threadneedle Investments. We're a large global asset manager. We've got many strategies, capabilities that we can apply for the benefit of the trust, and we use a number of those strategies, such as our exposure in European equities and in some of our US value strategies, but we also employ third-party managers. So, for example, JP Morgan, based in New York, run a large cap growth strategy for us, looking at fast-growing US stocks. Invesco run an emerging market strategy for us. And we also blend exposure using Columbia Threadneedle Investments' expertise in private equity and third-party managers, where we use Pantheon to provide exposure to venture and growth. So I think there's many benefits that we can provide in terms of scale, access, and cost structure as well. Because of our scale, we are a low-cost solution for shareholders.
And cost obviously is a really important thing. And one thing you've just said just then that jumps out to me is obviously the name Invesco. That's something that I've seen on the way that the platforms that I personally invest in, and I assume the majority of the UK who do invest, what they see as well. But I think that the key thing to point out here is, I don't know if this is right, and I'm hoping you can clarify this for me. You're trusted with about £6.8 billion. What does that feel like? I can't even picture that amount of money.
Well, as I said, we're a substantial trust, and that is a lot of capital. That is a lot of shareholder money in which I and wider team, and obviously the boards, are entrusted with. It's a responsibility, but it's also a privilege. We have to recognise that this capital is shareholders' savings being deployed by us to fulfil, or hopefully fulfil, their financial objectives in terms of meeting their retirement needs, day-to-day living expenses, school fees for themselves or for their wider family. So it's a big responsibility, but it's a tremendous privilege. And one of the great aspects of the job is meeting the shareholders, and the shareholders own the company. And you really get a sense of the importance of the financial outcomes that we deliver for shareholders in those conversations, what it has enabled shareholders to achieve or to do through their life. And we've got many, many long-term shareholders for the trust.
Well, it's actually amazing that you make that point around what the average person's life, or the people who are in your fund, and that's something that I think a lot of people can take away and really, really see that stuff like F&C are looking out for everyday things that happen, whether it's, as you say, sort of school fees, whether it's, I don't know, weddings or anything like that, just your general everyday expenses. But I think something that might be interesting for viewers to understand is what principles are you using that you go back to again and again while also trying to keep, on top of the many different things that are happening all over the planet which can affect the markets.
Sure, there's a lot of short-term noise, so I think it's really important to focus on principles, and that gives you an anchor, particularly during volatile times. The first point I make is the objective is long-term growth in capital and income. In terms of meeting that objective, we focus very much on growth assets. In the long run, we expect that listed equity, stocks and shares and private equity will deliver against that long-term objective of growing capital and income through time. And it's a really important point that the longer one holds an equity market or index rather than an individual share, the greater the probability of a positive return and the lower the actual delivered volatility. So it's really important to have that long-term perspective. The other point I would make is diversification is really, really important. For reasons that are perhaps less obvious to some of your listeners, I think people know the principle of not putting all your eggs in one basket. And from a multi-asset perspective, you can think about potential shock absorbers in the portfolio that will perhaps perform when other areas of the portfolio are not. But within listed markets, there's only a very small portion of companies that actually drive long-term returns in markets. And one of the biggest risks you face as an investor in equities is not having exposure to that small number of very highly performing companies. So we look to provide a diversified exposure which increases the chance of exposure to the winners, reduces the chance of exposure to the losers, and tilts the probability hopefully in favour of better long-term returns for our shareholders.
So we're talking about a fund, a load of stocks all put into one basket where the funds that don't, where the companies that don't perform as well are protected against, say, the ones that do really perform well. And I think something that you've hit on there, which I personally feel is very, very important, and I talk to a lot of the people online that follow me, is about long-term investing. So are you seeing a shift more towards long-term investing in, say, big kind of things like you're doing, as well as sort of the everyday person?
I think it's really difficult, actually, because I think we are inundated with information sources from social media, from conventional media and elsewhere, and that creates a tremendous amount of noise. So I actually think there's a tendency for people to think shorter term rather than longer term, and confuse what might be longer term trends with short term phenomenon. And we've had numerous instances of that, obviously, in recent years, where COVID, for example, we saw people confusing what was actually, with the benefit of hindsight, a relatively short-lived phenomena with tremendously consequential outcomes. But from a company perspective, certain companies being assigned as long-term winners, when in the environment actually in which that was assessed changed quite fundamentally. Lockdowns ended, people got back to working in the office in many instances, and that changed practices. So I think that it's a real challenge for the professional and non-professional investors to retain that focus on the long term. But it's really, really important, certainly when one is allocating capital, to consider equities in a long-term context. Without wanting to contradict myself, however, again, we do go through periods of very significant disruption. We're going through a period now, and frankly, it's going on all the time. And one has to be very careful and thoughtful about the permanence of trends. Numerous examples through history, not just COVID, Kodak. We used to talk about Kodak moment being a moment that we would remember an event because we'd take a photograph. Kodak moment now really is remembered as Kodak disappearing as a meaningful company in its original form. Why? Because they didn't adapt to digital. They stuck with the conventional methods of producing photographs, despite inventing the first digital camera back in 1975. That company did not thrive.
They didn't think it would stick, did they?
They didn't think it would stick.
No. Yeah. So what would be the term now, a Kodak moment? Because I'm sure many of the viewers of this video will probably not really understand what that is. So maybe Instagram moments or something like that, some social media stuff. But I think you've hit on the COVID having a massive effect. Are there any other drivers that sort of, affect the markets? Any big sort of categories that you're seeing at the moment?
So when we think about investment in equities, beyond this long-term perspective, in the long run, equities are providing you with exposure to growth because they're driven by cash flows of companies. And in the long run, cash flows of companies in aggregate tend to grow, driven by productivity improvements through time and economic growth. But there are a number of shorter term trends that are really important in terms of driving outcomes for investors. And a lot of them relate to what's going on in terms of the local and global economy, how that's impacting individual sectors, the overall interest rate and inflation outlook. And there's many what we call macroeconomic influences in terms of short term equity outcomes. So company cash flows when the economy is doing well. Companies tend, all else being equal, to do better. When there's a recession, companies will tend to struggle on average to generate profits to the same extent that they will during the good times. Similarly, when interest rates are going up, there's more competition for capital, so equity markets might trade a little bit more cheaply than when interest rates are low. So there's a number of macroeconomic factors, there's a number of thematic factors. Big theme right now, there's several big themes. There's geopolitics, which is a constant issue clearly in terms of what's happening in the US.
Yeah,
particularly
we're seeing it all over the news at the moment.
All over the news. Obviously, as we speak today, there is military action in Iran and spillover consequences to the rest of the Middle East. So that's having a knock-on impact in terms of oil prices, people concerned about what that means for inflation, perhaps interest rates, and indeed growth, and also supply chain disruptions globally for individual companies. So we saw again some of that during COVID, when cars, for example, rely on thousands of individual parts sourced from across the world. When you miss some of those parts, you're not able to produce the finished product. So there are concerns about what's happening from geopolitics specifically today, but on an ongoing basis. Technology, again, is a constant source of opportunity and threat. Opportunity in terms of the growth dynamics that can bring to the wider economy, the companies that will benefit, but technology also creates threats to individual companies, right?
So things like AI, I guess.
AI is a perfect example. There's a lot of excitement about what AI can do in terms of productivity improvement. But the flip side of that is perhaps displacement of workers. We've seen that through history when new technologies are adapted by companies. That has an impact on the workforce. There's going to be winners and losers, substantial winners and losers from this profound technological change that's ongoing. And then the third aspect, geopolitics, AI, is climate change. Climate change is real. Having a real impact on the wider environment now in terms of insurance premiums, operations, water scarcity, any number of aspects. So that is the third aspect. So I think the third aspect, which is really having an impact in terms of markets right now.
And are there any of those that you're particularly focusing on over, say, the next 5-10 years, or are you focusing on all of them? What's your kind of strategy?
So they're all extremely important, but I would say AI is the area that has the focus, again, notwithstanding heightened risk from geopolitics at the present time. Why do I say that? Because F&C invests into equities. Equities, listed stocks, are driven very much by economic growth outcomes and related corporate profit outcomes. AI is going to have a very big impact, I think, in the medium to longer term on the profit outlook for the corporate sector overall. It's going to be able to replace many tasks which are undertaken today. That may well lead to some improvements in productivity in certain areas, but probably in aggregate overall. For the corporate sector, conversely, it is going to lead to some challenges for labour in certain aspects of the market. So the market right now, and there's examples of this in the software sector and elsewhere, is looking for future winners. The hyperscalers, as we call them, Amazon, Meta, and Alphabet and so on, are spending hundreds of billions of dollars in capital expenditure to build data centers to power the AI revolution. It remains to be seen how profitable some of these investments will be. But when it comes to the impact of AI on the wider economy and corporate sector, we think it'll be a net positive.
Absolutely. And when you're talking about productivity, it's something that actually the government is pushing a lot at the moment. From my chats with the Chancellor, Rachel Reeves, she has a big focus on trying to get the UK more productive. And I think a lot of people are, instead of necessarily thinking about what they can do, they're trying to find things. They're trying to suss out what is out there at the moment that they can capitalize on. So I think a great example of that is AI. But are there any sort of misconceptions you are seeing flying around about AI or anything else?
I mean, as usual, there are general rules that can be applied to some of the specific phenomena that we're seeing right now. So there is a law. Many rules are assigned the term of a law, Amara's law. Typically, the observation is that people overestimate the short-term impact of technological change, and they underestimate the longer-term impact of technological change. That has been true through history, whether it's electrification, computing being applied in the workforce, or the internet. Why that happens is there's a lot of excitement, there's a lot of hype, and that hype tends to lead to some exuberance in the short term, which takes time to play out. So AI, I think, is somewhat different, and it's very, very dangerous to say that it is different this time, but AI is to some extent different. The reason being that while it does require a lot of capital expenditure or spending on infrastructure to support the rollout of AI, for the end users like you and I or people in the workforce, they actually have the technology in many instances to apply AI already. So whether that's your phone or your computer, you upgrade the software, or you use Claude, or use Gemini, or use ChatGPT. These applications exist on platforms already that you can use. So that contrasts actually with some of the historical examples where we have had to a great more of the front end build out to deploy the technology. So I think that, to repeat the point, people tend to get overexcited in the short term about the application of technology. AI could be somewhat different in terms of the speed of implementation, and the impact may well be faster this time than we have seen historically.
Yeah, and implementation is something you're seeing a lot at the moment with companies integrating AI into their general systems. So for me personally, when I upload a video to my short-form social media platforms, say TikTok and Instagram, specifically Instagram have a feature where they will rewrite your description using AI. So you saying that this is slightly different, for me, yeah, it feels different. It's starting to work into so many different parts of people's lives that I think it is something that people need to take a little bit more heed of. And especially when they're talking about investing, I think that with a lot of terms are being thrown around, like an AI bubble, and I know a lot of funds, some of the most famous popular ones, let's say the S&P 500, which is what, you know, the average person kind of sees online and invests into. Do you think we're at the point where this is going to become so big that we should be focusing more on it, or do you think it's more of a passing trend? I know you've kind of said that already, but is there one or the other, or is it a sliding scale?
I don't think it's a passing trend. Technological innovation and progress is constant through time. AI is progress on prior technological improvements. And however you want to frame it, I think that technological improvement through AI, large language models and related applications will have a significant impact in terms of many roles going forward. As you've given an example, I've got many examples myself of using AI to help me in my role. It doesn't mean my role has disappeared yet, but it means that I can be more efficient in the production of output. I can produce more. I can produce higher quality output. And I think that experience that you and I have will be replicated far, far more widely. And it's often difficult to conceive exactly how and where the benefits will be felt. Again, numerous examples of electrification, and you have a general purpose technology that is adopted, but then it begins to permeate many, many aspects of daily life. And from there, further innovations follow. So I don't think this is a passing trend. It's being used in drug discovery. It might be that the first drug that was discovered and designed by AI, Rentocerta, which was discovered last year, may get regulatory approval this year, maybe next. But that is a real outcome that AI is delivering, which will have a positive impact for many people suffering from a specific lung disease. And it's been produced far more quickly at far lower cost than would have been possible previously. So I think that technological improvement, AI and related applications, is really going to continue to drive productivity meaningfully from here.
And talking about AI taking over people's jobs, one thing I'm seeing a lot online at the moment is people using AI for financial advice and investment advice, which I wouldn't necessarily say is a great idea, but what I've experienced these say ChatGPT doing is it will focus on big trends, looking at the big funds, the big companies, and kind of direct people more towards that. But from your perspective and your experience, we know that sometimes the best returns can be from a lot smaller companies, like diamonds in the rough. But how do you balance investing in, say, the big companies, the ones that are at the top of the stock markets, and also trying to find smaller companies which have the potential to have even bigger growth?
It's a great question. So there's this phenomenon called skew in the equity market, which is a statistical term. But what it says is that there is tremendous concentration in terms of returns within equities. So I made the point that the longer you hold an equity index, the higher the probability of return from that index over a longer time period, and the lower the overall risk. But within the market, which is made up of many, many individual companies, there's only a very small number of those companies that actually drive the overall return in the long run. And the statistics are really quite staggering, and they've been used widely, actually. They were popularized after a professor at the University of Arizona published these results several years ago. But 4% of companies in the US, and it's a similar experience globally, have driven basically all the return in stock markets. And around 0.3% of companies have driven about half of the return. And most companies underperform cash or lose value entirely. So what do you do with that information? Well, this is the kind of needle in the haystack, the diamonds in the rough. There's only a small number of companies that really make a difference. What do you do about that? You can take one of two extreme views, neither of which I think is appropriate. One, you focus all your time trying to find those needles in the haystack. And that is very, very difficult. It's possible, but none of us have got perfect foresight. And by concentrating your exposure, focusing on those needles, you're actually more likely to miss the winning companies. So one needs to be balanced, I think. The alternative approach is to buy the market. You just buy an index. And buying the index will, by definition, give you exposure to the small number of outsized winners, but it'll also give you exposure to the very large number of losers. So the way that we seek to address this challenge is by diversifying across specific strategies, using skilled managers who select stocks from different parts of the market haystack. You can think about the market haystack as being geographic or sectoral, so emerging markets, US, technology, healthcare, however you want to cut it, as well as thematic, so AI-driven stocks, for example, AI winners, AI losers, capital heavy, capital light stocks. So we use skilled managers to run a range of focused portfolios for us, and we blend those portfolios through the principle of diversification, because diversification enables you to add returns while reducing risk. So we look to tilt the probability of increasing our exposure to the outsized winners, but reduce the exposure to the numerous losers, which actually are dominant in the market. And we've got some good examples actually through time. We invested in F&C invested in Facebook, as was then Meta back in 2005. Mark Zuckerberg was 21. Wow. It was a $100 million company. The market cap, when I look today, is about $1.6 trillion. We invested.
So a slight improvement on
a slight improvement. That was one of our more successful investments. Yeah. And Amazon, we invested in Amazon. It was a $10 billion company in 2006. I think it was about 10 years old at that time, but it's now gone on to be a more than $2 trillion company. So these are the needles. These are the small number of companies that really drive outsized returns. But by casting our net wide, focusing in on specific segments and using specialist managers, we increase the chance of actually having exposure to these smaller number of companies that really play a very significant role in terms of driving overall returns. So diversification is really important.
But when you say that these funds, some of the big ones that everyone invests in, that the majority of people invest in, the majority of the growth in that is from a specific, well, the top end of that. A lot of people might see that and think, oh, well, if I can get the majority of the growth from just a few companies and then some, why don't I just invest specifically in those rather than a fund? And that leans into what you were saying about diversification and weighing up different economic markets. So say investing in the US or investing abroad in the UK. But that's an example of maybe a mistake that someone might fall into. But are there any other sort of mistakes you see people making, or you think that people should avoid making?
So I think your point in terms of there's different ways to interpret market capitalization, concentration, or the concentration of a small number of companies at the top of market indices. That concentration is a result of past performance. Mm-hmm. So those companies at the top of the market, the leaders, tends to change through time. If you look at a decade by decade list of the winners, there are a few exceptions, and Microsoft is one company that's adapted phenomenally well in recent decades.
Adopting AI and things like that.
Adopting AI and actually diversifying their business model to take advantage of cloud computing, for example, and storage beyond the traditional software area. So there are a few examples of companies that, not necessarily permanently, but over very long periods of time, manage to maintain their winning edge. But the reality is that the winners do tend to change through time. And therefore, while you have to have a long-term perspective, one can't be complacent if you're looking at individual stocks, because the moat or the protection that companies have around their business, their competitive advantages will change through time. And in many instances, it erodes. And it can erode quite quickly. And again, to the discussion on AI, the market is trying to assess for software companies specifically in focus right now, how permanent is the moat that these companies have had when AI may actually be able to replace a lot of the utility that these companies actually provide. So one needs to think about balancing that long-term perspective against what obviously is shorter-term dynamics. But in general, and in response to your specific question, mistakes that people make, we all make mistakes as investors. One of the tremendous challenges in terms of professional investments is it's as much about what you miss as what you have done, i.e. the things that you could have done to deliver better outcomes. You can always look at the mistakes that you've made, or the decisions that you made that or not made that could have led to better outcomes. But I think the biggest issue for investors is maintaining a long-term perspective, regardless of short-term noise, particularly when it comes to geopolitics and short-term economic phenomena. From a corporate perspective, it's a bit different actually, because as I said, micro influences, moats do change through time.
And I think, just to give you a bit more of like a personal story on that kind of thing, is I've talked about this on my social media before, but something that actually happened to me, and one of the biggest mistakes I ever made when investing is, I don't know if you remember, but I think it was probably around 8 years ago, 7 or 8 years ago, there was a massive drop in the value of oil. And there was this huge thing, and I remember seeing it in the news, and I remember thinking, God, this is something that I can jump on. And my dad had just introduced me into investing. He said, look, let's start a small investing pot together, but £200, let's just play around with it, basically getting me into the kind of mindset of future investing. And I remember that we put a little bit more money, and eventually we worked up to around £2,000. And during that time, I saw this happening. And on the theme of trends and jumping on things for short-term gain, I saw it dropping, and I was like, I'm going to get on this. I'm going to put some money in. So I cashed in my investments and shorted oil, which is obviously where you're betting that the stock will go down. And I put a 10 times leverage on it as well, which means that if something goes down by 10%, you've made 100%. And that worked really well for me for the first couple of hours. And I went from about £2,000 to about £7,000 or £8,000. And I remember thinking, God, I'm so good at investing. I'm doing absolutely brilliantly. And then the price started to stabilize, and it had been automatically cashing me out when I hit a certain profit, and I'd then just been reinvesting. And I remember at the end of that day, I calling my dad and saying, Dad, our £2,000 pot? Well, it was worth £8,000. Now it's worth £1,000. And I lost half of the money that we'd built up over the past couple of years, all on that kind of thing. And I think that is the reason I tell that story is it's very pertinent to say that as someone who I would consider myself a personal finance expert, I know everything about credit cards, I know everything about general day-to-day expenses and how you can save money, but mistakes do happen, and people can very, very easily fall into the news cycle and these trends and get really, really caught up in it. So I guess to kind of round things off, is there something, for instance, my massive mistake there, I came away from that saying, I'm not going to mess with leverage again, and I don't even really want to mess with shorting, even like when it's in the news. But is there a rule, or is there something one thing that you would say to someone, if you're going to consider investing, if you're going to start putting your money and saving for the future, what is the one thing you would say to them?
Well, Matt, what you've described, I think, is classic speculation, right? Mm-hmm. And employing leverage, and that's not a great combination.
No,
I mean, as you described, you had fantastic short-term gains, but they evaporated and the leverage amplified.
It was in 6 hours. Losses. It was all over the space of a tiny period of time.
And frankly, you're lucky you didn't go into, actually owing money in terms of that trade. So that's a great example, I think, of speculation, short-termism, and chasing trends. Applying leverage on top is really compounding, I think, the mistake. But on the point of compounding, I think this long-term perspective in combination with diversification, so I'm being greedy, there's 2 points here, and I'm repeating myself, long-term and diversification. Why long-term? Because Einstein allegedly called compounding the eighth wonder of the world, right? You earn gains on the gains, whether it's interest or capital gains. When you reinvest, that compounding effect is really quite remarkable over long periods of time. And just as an aside, we have F&C, and it's beyond most people's time horizons, I accept, turned a £100 investment back in 1868 into over £25 million today.
Wow.
Now, that's a phenomenal growth in terms of the absolute gain, but the actual annual return is a bit over 8%, I think, in terms of what that is, 8% per annum over a very long period of time, compounds up into something truly remarkable. And we know that a 7% per annum return over 10 years basically doubles your money. So time is your friend. Patience in terms of investment when one is looking at growth assets like equities is really a very, very sensible approach, because you can compound gains on gains, but you need to be diversified. Your point about picking an individual commodity, not diversifying, again, I think is a classic mistake. So diversified approach in terms of your choice within the asset category. For me, a focus on growth assets, if one has got the patience and the time horizon and time is on your side to let that compounding effect really pay off.
So time in the market, not timing the market, as in stay in there for longer, don't try and buy and sell and look at what the news is doing. And diversification, making sure your investments are spread over multiple different things so that if something does really badly, it can be outweighed by something that potentially has the opportunity to do well. So a more even trajectory.
Exactly. I just make one additional point on that. I mean, volatility in equity markets is normal. It's uncomfortable. It's uncomfortable for everyone, but it is not normal. It is not abnormal, I should say, for calendar years to show reasonably meaningful losses within that period. We had one in 2025 when we fell by almost 20% in US equities after Donald Trump announced Liberation Day, and markets took that badly in terms of the impact of tariffs. But the lesson of experience is that over the long run, markets do tend to produce positive returns in terms of wider equities. So right at the volatility, I think, is the message.
Paul, thank you very much for your time. Are there any final thoughts or anything you want to say before we sign off?
Well, it's been great to speak to you, Matt. I think as we're talking about F&C Live today, we are living through an age of upheaval. There's three really significant influences in the world today: geopolitics, AI, and climate change, and they're all impacting simultaneously in terms of the impact on economies and indeed markets. That means that it's a period of volatility, uncertainty, and wider upheaval for us as individuals, and also potentially for markets as well. But as we've discussed, I think the lessons are: one, take a long-term perspective; two, be diversified in terms of your exposure; and three, one of the tremendous advantages that we have had at F&C, as I said, launched over 150 years ago, is adapting through time. So knowing when to change, knowing when to adapt approach, to take advantage of opportunities and tilt the odds in favour of better outcomes for shareholders.
Thank you, Paul. It's been great talking to you. I'm chatting with more experts at F&C Live, so make sure you stay tuned in. So it's bye from me and bye from F&C.